The question is, why did the MPC decide to keep policy rates flat today? In our minds, it revolves around three arguments. The first one being that in the States, at the last policy rates meeting, the FOMC, the Federal Reserve's equivalent to our MPC, they decided to keep rates unchanged. So on the back of that, it gave our local MPC a bit of room not to hike rates. Secondly, the latest inflation print, which is for June, is now within the policy rate target, printed actually better than expectations. So again, it provided them ample argument that they don't have to hike. And thirdly, it buys them time, if they don't hike now, to have more data at the next meeting to make a better decision and to prevent policy rate errors. So what might still drive policy rates higher ultimately? Two things. To the extent that the FOMC is not done hiking in the States, that might influence our policy rates. Secondly, in the MPC statements, the risks to the supply side of our economy was highlighted. Firstly, we've got logistical constraints. Secondly, there are electricity supply issues with the local economy. And thirdly, we've got weather conditions that might actually impact the size of the crops that we grow in agriculture. So, if we combine the supply side risks with the fact that the FOMC might actually hike later into the year, then there are possible risks for another hike going forward. So, what does the latest policy rate announcement mean for consumers? I would argue for the average household, it is a bit of a breather. It creates a bit of a breathing space because at least there isn't an increase in the cost of borrowing. However, going forward and looking forward, there is a possibility of another policy hike over the next 3 to 5 months, which means the pain for consumers isn't over yet, and the average household will probably experience a little bit more pain going forward. So any household really needs to assess whether they want to take on more debt in this environment, given the possibility of another policy rate hike going forward. Given that we are so close to the peak in policy rates, what does it mean for investors and the way that investors are going to position their portfolios? So let's just look at the different asset classes. Money market managers will probably try and move up the yield curve in order to extend duration, because in a flat to falling rate environment, you do want longer term assets with a longer duration. Bond managers will probably also want to increase their duration generally, because in a falling inflation / policy rate environment, you benefit from being long duration. And then equity traders will definitely also have an increase in risk appetite, simply because with flat to lower policy rates, it improves the outlook for equities.